Hey everyone, it's Rachel. Today, I want to take you through one of the most dramatic moments we've seen in the world of cryptocurrency. Whether you're a seasoned investor or just crypto curious, what's happening right now is sending shockwaves through the entire financial landscape. Over the past few weeks, the cryptocurrency markets have been thrown into chaos. The energy and optimism that once fueled this space have been replaced by confusion and fear, as prices swing wildly and fortunes change overnight. The digital currency markets, once soaring to new heights, have hit serious turbulence. We're seeing sharp declines that have wiped out months, sometimes years, of gains in just a matter of days. Investors who were once celebrating their profits are now glued to their screens, watching as excitement turns to anxiety. The uncertainty is palpable, and it's affecting everyone from small-time traders to major institutions. Major coins like Bitcoin and Ethereum have seen significant drops, erasing the feeling of endless growth that defined the last bull run. The sense of invincibility has vanished, replaced by a sobering reality check. Many who hoped for quick gains are now facing the harsh reality of volatility. Dreams of overnight riches have been replaced by tough questions about what comes next, and whether the market will recover. This isn't just a minor dip. Multiple forces have collided to create a perfect storm. It's a moment that's testing the nerves and strategies of everyone involved. Global economic pressures, shifting investor behavior, and technical signals are all pointing down. Add to that regulatory uncertainty and sudden shifts in market sentiment, and you have a recipe for extreme volatility. In this chapter, we'll break down the events of the last few weeks, especially the historic crash in October 2025. We'll look at how the news unfolded and how it impacted both the markets and the people behind the trades. We'll explore what triggered this dramatic downturn, who's selling in panic, who's buying the dip, and what all of this could mean for the future of digital assets. We'll also touch on the lessons investors are learning the hard way. My goal is to help you understand this complex situation so you can make smarter decisions, whether you're thinking of investing, holding, or just trying to make sense of the headlines. Let's dive in and unravel the storm shaking the crypto world. October 2025 was a disaster for crypto investors. The market saw the largest liquidation of digital tokens ever, $19 billion in forced sales on a single day. Liquidation happens when investors who borrowed money are forced to sell at a loss because prices dropped too far. This wipeout was 9 times bigger than a similar event earlier that year, and 19 times bigger than a major 2020 crash. As prices fell, liquidations triggered more selling, creating a vicious cycle. Many investors woke up to find their accounts emptied overnight. The event exposed just how much risk and debt were propping up the market. It's a brutal reminder: high returns come with high risks. The October crash will be studied for years as a lesson in market fragility. What caused this historic crash? It started with a major escalation in US-China tensions. The US threatened massive tariffs on Chinese goods and announced tighter software export controls. This signaled a serious escalation in the trade war, creating global economic uncertainty. Crypto, being a 24/7 global market, reacted instantly and dramatically. Investors panicked, selling risky assets like crypto to move into safer investments. The news from Washington was the spark that triggered the sell-off. Crypto doesn't exist in a vacuum. It's deeply tied to global finance and politics. Events that seem unrelated to Bitcoin can have a direct impact on its price. The threat of tariffs and export controls was the direct cause of the biggest wipeout in crypto history. It's a crucial lesson. Global events can shake the crypto world. Bitcoin, the undisputed leader of the crypto market, found itself at the center of a storm during this period of intense financial turmoil. Once hailed as the digital gold and a safe haven for risk-tolerant investors, Bitcoin's dominance was suddenly challenged in a way not seen for years. While global stock markets surged ahead, fueled by a wave of optimism around artificial intelligence and new tech breakthroughs, Bitcoin was left behind. For the first time since 2018, it posted a losing month, breaking a long streak of resilience and growth that many had come to take for granted. On November 9, 2025, Bitcoin's price briefly slipped below the crucial $100,000 mark. This wasn't just a number. It was a psychological barrier for investors, and its breach sent shockwaves through the entire crypto community. Screens flashed red, and traders watched in disbelief as the king of crypto faltered. This dramatic drop marked Bitcoin's weakest point since June, officially pushing it into bear market territory. The price had fallen more than 20% from its recent peak, a clear signal that the bullish momentum had reversed, and a new, more uncertain phase had begun. The fall from its record high was more than just a number on a chart. It represented a dramatic shift in sentiment. The optimism that had fueled months of gains was replaced almost overnight by caution, anxiety, and a sense of vulnerability among investors. When Bitcoin stumbles, the entire crypto market feels the impact. Its influence is so profound that a sharp decline can trigger a chain reaction, pulling down the prices of nearly every other digital asset in its wake. Most altcoins are closely tied to Bitcoin's performance, and as the flagship currency fell, so did the rest of the ecosystem. Projects that had been riding high on investor enthusiasm suddenly faced steep losses, and the entire market entered a period of collective pain. The drop was a clear signal. The party was over, at least for now. The euphoria that had defined the previous months gave way to a sobering reality as traders and investors realized that the good times don't last forever in the world of crypto. For those who had bought in at higher prices, the sudden downturn was devastating. Months of hard-earned gains vanished in a matter of days, leaving many to question their strategies and reconsider their risk tolerance. The King's Fall sent ripples throughout the entire kingdom. When Bitcoin is under pressure, every corner of the crypto world feels the strain, from major institutions to individual investors. As the dust settled, it became clear. A colder, more cautious season had begun for crypto. The market's exuberance had given way to a new era of uncertainty, where every move would be watched with wary eyes. The crash was made worse by the widespread use of leverage, borrowing money to invest. In the world of crypto, leverage is often seen as a shortcut to bigger profits, but it's a double-edged sword. Many traders, lured by the promise of multiplying their gains, took on more risk than they could handle, not realizing how quickly things could unravel. Leverage amplifies gains, but it also amplifies losses just as quickly. When prices move in your favor, the rewards can feel almost magical. But if the market turns against you, even a small dip can trigger massive losses, wiping out months or even years of savings in a matter of hours. In early November, over $1.27 billion in leveraged crypto positions were wiped out in a single week. That's not just a number. It represents thousands of traders who saw their investments vanish almost overnight, as exchanges automatically liquidated their positions to cover the borrowed funds. Most of these were long positions, bets that prices would keep rising. Many believed the bull run would never end, and piled in with borrowed money, convinced they couldn't lose. When the market turned, everyone rushed to sell, accelerating the crash. Panic set in, and the sell-off became a self-fulfilling prophecy, driving prices even lower and triggering more liquidations. This is the danger of leverage. A small dip can wipe you out before you see any long-term gains. The domino effect is real. One person's loss can trigger another's, creating a chain reaction that's hard to stop. For most people, leverage trading is more like gambling than investing. The odds are stacked against the average trader, and the emotional roller coaster can be overwhelming. The promise of quick riches often ends in devastating losses. Stories of overnight millionaires are rare, but tales of people losing everything are far more common. The lesson: only invest what you can afford to lose. It's tempting to chase big wins, but protecting your financial future should always come first. Professional traders may use leverage strategically, with strict risk controls and years of experience. But for everyday investors, it's a trap that can quickly spiral out of control. The leverage trap springs shut fast, leaving many with nothing. Once caught, it's almost impossible to recover without starting over from scratch. The October and November crashes showed just how risky this strategy can be. Even seasoned investors were caught off guard by the speed and scale of the collapse. It's a powerful reminder to manage risk carefully, stay informed, and never let greed override good judgment. In the end, surviving the market is about playing the long game, not chasing shortcuts. Analysts at Citi have noticed a shift in who's buying and selling crypto. The number of Bitcoin whales, big holders, has been declining, suggesting they've been cashing out. Meanwhile, more small investors are jumping in, often driven by FOMO. This pattern is common near market tops. Experienced players sell while newcomers buy. Ownership is shifting from strong hands to weaker ones, making the market more fragile. When fear hits, these new investors are more likely to panic and sell, fueling sharp declines. Technical indicators also tell the story. The 200-day moving average is a key signal. When Bitcoin trades below it, that's bearish. Right now, Bitcoin is below this line, scaring off big investors and automated trading systems. It acts as a ceiling, making it hard for prices to recover without strong positive news. Another warning sign: declining funding rates. When funding rates drop, it means fewer traders are betting on prices rising. This lack of bullish enthusiasm shows the market's momentum has faded. Technical signals are flashing red, warning of continued weakness. Until these indicators improve, demand for crypto will likely stay low. The charts confirm the market is on shaky ground. So what's next? Experts say to watch the flow of money into spot Bitcoin ETFs. These ETFs make it easy for mainstream investors to buy Bitcoin through regular brokerage accounts. Strong inflows into ETFs would be a bullish sign, showing that new investors are buying the dip. If money flows out or inflows dry up, it's bearish, signaling more pain ahead. ETF flows are now the top barometer for market sentiment. The adoption of crypto as a legitimate asset class depends on these new investors. This is what the pros are watching most closely. We've covered the perfect storm, global tensions, historic liquidations, whales selling, and bearish signals. The key lesson: don't react emotionally or panic sell at the bottom. Use this time to review your financial plan and remember that crypto is high risk and speculative. Never invest money you can't afford to lose. For newcomers, this is a hard but valuable lesson in risk. For experienced investors, it's a reminder to manage leverage and watch the bigger trends. The path forward is uncertain. Watch ETF flows and technical levels for signs of recovery. But your personal financial strategy should stay steady: budget, avoid debt, build an emergency fund, and diversify. Crypto will always be a roller coaster, but your financial future doesn't have to be. Thanks for tuning in.